Welcome back. By now, you're probably tired of hearing people speak about WeWork. And you're right, we've beaten this dead horse often enough that we probably shouldn't revisit it. But I think I want to do one final post on WeWork. And in this post, I want to focus not on WeWork, but on, I think, the real culprit in this WeWork problem, which is SoftBank. I just valued WeWork, what, 4 weeks, 6 weeks ago? Since my pre IPO post on WeWork in early September, lots has happened. In fact, the IPO itself collapsed under the weight of what I think are its contradictions and the arrogance of the founders and the VCs involved. Eventually, after a long drawn out process, SoftBank emerged as a savior for the company, investing an extra 8 billion in a company where they'd already invested 7.5 billion, taking in fact a much larger stake in the equity. And as the story has continued to unfold, as I said, the focus really of the story has shifted from WeWork and all of its mistakes to SoftBank itself as a company. So, in this particular post, I want to look at SoftBank using the WeWork investment as kind of a vehicle for looking at issues, the company itself. So, let me give you a very quick review of what I found on September 9th when I valued WeWork for the IPO. I made key assumptions, in particular about revenue growth and operating margins, and I was pretty open about the fact that I was being optimistic in my assumptions. I did assume that they would have to reinvest to keep growing with the sales to capital ratio, and that their cost of capital would be the cost of capital of a real estate company eventually, 8% moving down to 7%. The issue I had with the WeWork business model is it's a mismatch model. So I talked about how the high, the operating leverage coming from the fact that they have long duration leases that they've entered into, but they lease out their space on short durations. And on top of that, if you capitalize lease commitments, you have a high debt to equity ratio, brought in the fact that there's a chance they will fail. In fact, I attached a 20% probability of failure. And finally, when I subtracted out the total debt, which translates into a lot of money, $24 billion with the lease commitments included, I arrived at a value of equity before I adjusted for the IPO proceeds of just about 10 billion. That was my IPO valuation on September 9th. In hindsight, you're saying that was hopelessly optimistic. I'll take it for whatever it's worth. It was well below the 47 billion that software was being priced at prior to the IPO transaction, but I arrived at about 10 billion. And I did do a table when I did my IPO valuation to describe this company as a company on the edge, on a knife's edge. And what I meant by that was the incredibly high leverage and the duration mismatch meant that if you just tip the company in either direction, the value could either explode to become a really large number or implode to become a negative number. In fact, if you look at the table that I put out, depending on your revenue growth and your margin assumptions, you end up with a lot of negative values. In fact, about half of the time you end up with values for equity that are less than zero. So on September 9th, while I gave a valuation of 10 billion, 13 point something billion if you included the IPO proceeds, I also said this company could very quickly tip over. I didn't expect the implosion to happen as quickly as it did, but the ground shifted under WeWork incredibly fast for many reasons. One is the arrogance shown by Adam Newman and the VCs involved in the process, and the fundamental weakness of the business model caught up with WeWork. When the IPO got delayed a week after my post, the company went into a tailspin because it had a cash crunch. It had debt payments coming due and not enough cash flows. It had been hoping to use the capital raised from the IPO to cover those cash needs. So very quickly, the story went from IPO, the high-flying big IPO, from WeWork, from being a big high-flying IPO, to question of whether it would make it. And so by early October, the question was, will the company survive? And talk about rescue started to fill the air. JP Morgan started to put together a rescue offer built primarily on very risky debt. I thought it was a horrible, put together transaction. I don't see how WeWork could have survived it. But SoftBank came in with its own rescue package. And if you break down the SoftBank rescue package, here are the pieces to it. SoftBank put in a $3 billion tender for the equity to buy out existing equity stockholders to raise their stake in WeWork, which they ordered at a pretty substantial stake to 80%. In an interesting twist, though, they said they would not have voting control of the company even with that 80%. Whether this was a ploy to make sure that WeWork would not get consolidated into the SoftBank financials, in which case SoftBank would have to show the 24 billion debt, or whether this was true, whether it was a true description of the fact that they wouldn't have voting rights. SoftBank became the lead equity investor in WeWork after the 3 billion equity offering. In addition, SoftBank offered a $5 billion debt offering, where the details are a little fuzzy, 5 billion, and they offered to also accelerate $1.5 billion that they'd offered to invest in WeWork's equity earlier in the year. They offered to accelerate that investment. So in sum, SoftBank agreed to invest an extra 8 billion and put in the 1.5 billion they'd already agreed to. And finally, as part of this package, they tried to neuter Adam Newman for a price. They paid him $1 billion in cash, a $500 million to pay off a loan from JP Morgan that he had, and $185 million as consulting fees. I think it's really less consulting fees and more just stay the heck away from WeWork fees. Basically, they'd given him so much power in terms of voting rights that the only way to make him go away was to pay him a huge ransom, and they did. So this was a huge rescue, and there are big questions that come out of this rescue. First is, what is it that motivated SoftBank to take a company where they'd already lost so much money and invest so much more? And we look at the alternative hypothesis and which one we think is supported more with the facts. Second, the whole issue of accounting fair value is very easily put under the microscope when you look at the SoftBank investment in WeWork, because we're going to look at what the accountants did with the WeWork mistake, how it plays out, and whether in fact fair value accounting is at all, of all any use in detecting problems like that like the one in WeWork before the fact. The third is almost an existential question. We talk about smart money and stupid money. Is Masa Son a visionary genius, or is he an egomaniac in needs of checks and balances? That's a fundamental question that this SoftBank investment in WeWork has kind of brought to the surface. And finally, SoftBank itself is a holding company. WeWork is only a piece of all of the other holdings they have. Does how SoftBank the way SoftBank has dealt with WeWork now has consequences for how investors view all their other holdings. How is that going to play out in SoftBank's own stock price? Let's start with the first question. When you look at that $8 billion invested by SoftBank, I'm not even counting the extra $1.5 billion that they accelerated. They agreed to that before this rescue package. There are two views you can take of this. One is, if they hadn't done this, WeWork would have crashed and burned and the value would have gone to zero. That by investing this money, they're in fact rescuing their own investment by making sure WeWork does not go under. So the first is, this is a corporate rescue. It's not going to bring their money back, but it minimizes their losses. The second is that this is just a bad decision. It's good money chasing bad. It's a sunk cost problem. If you in corporate finance and valuation, we know that the phenomenon of sunk cost is deep roots, which is people, instead of ignoring what they've spent already in the past, often bring in that effect of how much they've invested in the past or lost in the past into decisions today. In other words, they often spend more money so that they don't have to deal with the fact that they've already invested a lot of money. So which one is it? I don't think we can completely answer the question, but it is true that this rescue avoided a near-term liquidity crisis, right? You could have had a cash crunch, but it doesn't solve any of the fundamental problems that WeWork had in early September or even August or during its entire lifetime. Its business model is a model which is extraordinarily risky, and this is a highly levered company with a risky business model. What I see after this rescue is an even more highly levered company. They have extra 5 billion debt. And now you're going to put a cap on the growth rate. That was their only chance of escaping this pain, is they were able to grow. So if you cap the growth rate and you add more leverage, I just don't see a pathway where this company could be worth money. Masa Son, in his most recent remarks to his stockholders, claimed that the rescue's logic was simple. He said, time will resolve this problem, and we will see a sharp V-shaped recovery. I don't see the logic as simple. I don't see how time will resolve a basic business model problem of pay off the 30 billion in debt. And I don't see the pathway for a V-shaped recovery. Then pieces are not in place. So To me, at least, looking at at this investment, it seems to me more of a sunk cost problem than an actual rescue. That SoftBank is throwing a lot of good money after bad, and if you're a SoftBank stockholder, you should be terrified. And here's why: they had a sunk cost problem at 7.5 billion. Now that sunk cost problem has become a 15.5 billion sunk cost problem. So if they were being irrational after sinking 7.5 billion, think of what they will do if they have $15.5 billion. Something to think about. Second, let's think about fair value accounting. I have said lots of mean things about fair value accounting, and I mean every word of it. I think fair value accounting has lost its way. It never had a good pathway to success. And in many ways, what you see in SoftBank illustrates the weaknesses of fair value accounting. First, there is no fair value accounting is neither fair nor value. It's a fair price accounting at best. What I mean by that is all that fair value accounting requires to do is mark to market based on what people are paying for something, what somebody will pay for a business or an asset. So if you think about WeWork, if you'd looked at how SoftBank recorded WeWork in June or July of this year, they recorded it based on a $47 billion pricing. And if you look at why they wrote down that number by 4.6 billion in early November, just a few days ago, they wrote it down not because they revalued the company, but because their newest SoftBank rescue puts the pricing closer to 8 billion. And in fact, in this particular case, fair price accounting is undercut even more by the fact that both the $47 billion pricing and the $8 billion pricing came from SoftBank setting the pricing. This is almost self-referencing. SoftBank sets a pricing, then it marks up or down its pricing on its balance sheet. So this is a particularly weak fair price accounting. And by the time the accountants got around admitting there was a problem and writing off 4.6 billion, the market said, we know that already. This was a terrible investment in WeWork. So that's another problem with fair value accounting. By the time accounting writes down the price of an asset, everybody knows it's happened. And there are some dangerous feedback effects you worry about. Because managers seem to think accounting actually matters. So in order to avoid the kind of write-downs you see there, I think managers go through contortions. I wonder how much of SoftBank's rescue is coming with the fact that they worried that if the pricing dropped to zero, the write-down would be even more. I'm not saying that's the motivation, but you can see the kind of feedback effects you can have from fair price accounting. Third issue, I think the spotlight on SoftBank should make us rethink the notion of smart money or stupid money. You've heard the mythology about smart money. Smart money, you have people who have are smarter than the rest of us, have access to data, better models, and they invest well, and they make a lot of money, and the rest of us, of course, don't make money. So in the conspiratorial view of the world, there are all these smart investors making a lot of money, and the rest of us either have to try to track what they make and try to imitate them, or end up not making money. And 6 months ago, if I asked you where you would put Masa Son in that spectrum, you'd say, of course, he's a smart investor. Look at all the things he's invested in. He's a visionary. Now, that argument very quickly should be undercut by the fact that it's just a few months later and there are a lot of people saying some terrible things about Masa Son. Did he go from being smart to stupid in 6 months? I think what the WeWork misadventure illustrates is there's no such thing as smart money. You can have lucky money or unlucky money, and when you're lucky, you often look smart, and then you get classified as a smart investor until you stop being lucky. In fact, I'm going to suggest a different grouping that you should think about, and we should all think about. That investors are better grouped as humble. So if you want to classify money, rather than think of smart money versus stupid money, or lucky money versus unlucky money, I think we should classify investors into humble money and arrogant money. What's the difference? Humble money realizes that a lot of the time when you make money, it's because you got lucky, not because you were good. Humble money recognizes that you make mistakes because you're human. When you make mistakes, you should learn from the mistakes. And failure is an occasion to learn. Arrogant money thinks that, you know what, they can do no wrong. When they screw up, it's always somebody else's fault. Every loss is an affront. You double down on things. If I had to pick somebody to manage my money, I definitely want somebody who's humble money, not arrogant money. I want somebody who knows that they can make mistakes, that often when they succeed, it's more because of luck than skill. And it's one reason when I look at investing with other people, and I don't, if I looked at investing with other people, I'd look at how humble or arrogant they are. I'll tell you something. If you ask me for 2 and 20, which is the standard hedge fund money, that's already a sign of arrogance, right? To demand 2% of my wealth every year and 20% the upside, it's you're already putting yourself in the wrong category as far as I'm concerned. So with Masa Son, the question is, what is he? Is he now finally humble money now that he's made the WeWork mistake? Well, to begin with, his past suggests not, right? In a sense, this is a man who made a 300-year plan, and 300-year plans are almost a challenge to God saying, hey, I'm bigger than you. So he starts out with the presumption, let's face it, the years of success had made him a pretty arrogant investor. You're saying this WeWork mistake must have taught him a lesson, and at least the initial words he said at his shareholder meeting sounded good. He said, I made a bad investment decision, and he was deeply remorseful. Very Japanese way of saying you've made a mistake. Speaking of WeWork. But the words he used right after undercut his message. He talked about how Softbank was still better than everybody else in investing money, that how he was going to stay on task in terms of increasing his vision fund to hundreds of billions of dollars. So it's almost like with one set of words, he was talking about being humble. And the next set of words, he was saying, look, I haven't learned my lesson. So at least from my perspective, it seems to me that Masa Son still needs to learn a few lessons on humility. And guess what? The market's always ready to teach you those lessons. Finally, let's look at how this whole thing is played out with SoftBank. One way to look at how WeWork has affected SoftBank is to look at the market cap of SoftBank over time, which I've tried to do here. In this graph, I've looked at the market cap for SoftBank starting on August 7th all the way through November 10th. August 14th was the day the WeWork IPO was announced. Then you see September 16th where it's delayed, and October 23rd where SoftBank announced a rescue mission. And finally November 6th where they take the write-off. Between August 14th, the date of the WeWork IPO being announced, and November 6th, the day they took the write-off, SoftBank lost 14.26% of its value, roughly $15 billion in value. Clearly, this has had an effect on SoftBank. And to see why, think about what SoftBank is. SoftBank has a telecom center, but it's really a holding company for investments. Its biggest holding, in fact, is its most successful investment ever, which is the investment that Masa Son made in Alibaba. One of the ways you get arrogant is you get successful, and that success feeds your arrogance. In this case, the Alibaba investment was an incredible one. It's still in SoftBank and it's marked to market. But SoftBank has now become also a holding company through its part in the Vision Fund in lots of young companies. Ola, Oyo, Uber. I mean, Uber went public, but you can see it's not been the most successful public offering. So when you look at many of these holdings SoftBank still has, they're in private companies. You're saying, so what? One of the ways you gauge somebody who picks private investment, because in private companies, there's no market price you can observe. So you're trusting SoftBank to price these companies right. And second, you're trusting SoftBank to pick the right companies to invest in. WeWork dealt quite a blow on both counts, right? It showed that SoftBank is not a very good pricer. Look, think of the 47 billion becoming 8 billion over the course of 8 weeks. It also cast doubt on whether SoftBank is good at picking these young companies, because the WeWork investment looks bad, the Uber investment looks bad. So I am not surprised that people have lost trust, because with SoftBank it's all about trust, because you're investing your money in a company, but the company goes out and finds other companies to invest in. If you don't trust the company to make those investments, guess what you're going to do? You're going to discount the company. I mean, I think of SoftBank as kind of a twist on a closed-end fund. A closed-end funds often trade at discounts, and the less you trust the management of the fund, the bigger the discount becomes. Using that perspective, one of the ways you can see how much trust investors have lost in SoftBank is to look at the market price of SoftBank, market cap, against its book value. Okay? And in fact, you can compare it against the book value of its holdings, most of which are marked to market. So here's what I see. At least in November 2019, looking at SoftBank, it's had a steep rundown, and you saw how much of market cap it's lost. In early November, SoftBank was trading at about 123% of book value, well below what it used to trade at 2 years ago, 3 years ago, 4 years ago. But even more interestingly, it's trading at about 73% of the book value of its holdings. It's trading at about a 27% discount on the value of its holdings. You're saying, this is an incredible deal. Let me go buy SoftBank. Should you do it? It depends. It depends on what? It depends on whether you think WeWork was an isolated mistake. That if you still believe Masa Son is a great stock picker, that this was just one mistake, you should by all means load up on SoftBank. If, on the other hand, you think that this tells you a lot more about Masa Son, the investor, than you wanted to know, but now you don't trust him, well, maybe the 27% discount is a legitimate discount. Now I'm going to give away what I think by telling you what I've decided to do. I would not buy SoftBank. Let's do something about whether I trust Masa Son. Because this whole episode has brought out the underbelly of SoftBank and its biggest weaknesses. And until I can tell they've been fixed, I don't think that discount makes this an attractive investment. It might very well be deserved. And I hope you've enjoyed this talk.